Hello guys, Youthful Yields here. Today we're going to be looking at the performance of my portfolio for the last week. So starting off with the last week in review in terms of a total stock market, we can kind of see here just how that did. It was kind of a bumpy ride this week, but because we were coming off of the tariff announcement on Friday, there was an announcement. I think it was on Sunday that Trump basically said China was okay and it was mostly a misunderstanding. Then on Monday, the markets rallied again, and then there was an announcement that China did something with rare earth metals and so on and so forth, and also cooking oil, soybeans, all that stuff. So a lot of uh, Trump quote or Trump tweets that kind of took the market for a ride, but market mostly is up right now. Financials are somewhat down. A lot of regional banks are like down quite a bit. And yeah, I mean, there's just some companies obviously that are not doing too well, but others that are doing great this week. So we'll get straight into that. So, terms of the week as a whole as a review. So you can see the total portfolio did 2.32% this week. That beats out SPY at 1.74%. Composer did 2.67%. And M1 Finance did 2.19. Webull also went up. With that, there was also quite large of a dip on um, Bitcoin. And really, the entire crypto market as a whole. But if we take a look here for the past week, you can see there is quite a big dip after Friday. Or not, sorry, that's the wrong one. Last is the 12th, right? So yeah, there was this dip here. That was the Friday of the Trump tweet, and it just kept falling. It seems like it's coming back up a little bit, but this is somewhat expected because it's a cyclical thing. I've mentioned this in my past videos, but um, part of the reason, the reason I'm bringing this up is because our MSTZ position did go up. Fortunately, we're still down 78%, so obviously not amazing. And this very well could drop the next week if we take a look at this chart. It's done that multiple times before, so we'll have to see. But since I've been tracking it, it's been up 56%. So that's about since May, which is pretty nice. Yeah, I think that's about all we have for those. I also created this little thing. This is basically a month in review. This takes the percent gain from our total portfolio because ultimately that's what really matters the most here. So you can see it shows 3.49, but that was actually, I only started tracking this, I think, May 19th. So that could be why. Basically, could just have a bad week last week of May, for example. But ever since then, obviously, we've had positive months. So far in October, we've had 2.53%, with a total of 9.48%. Now, if we go on something like Seeking Alpha and go to SPY, I like to use Seeking Alpha here just because they have very good, or like their charting is very easy to just type in a specific date. So if I go 2025, May 19th, and apply, SPY is up 11.69%. So obviously that is beating our 9.48%, which sucks, right? And also, if we go back even further, that's going to be more of the case because we were, messing around with some high yield dividends, as well as we were in Webull, in our Webull portfolio, we did the MSTZ position, so we lost about $1,000 there. Well, yeah, almost $1,000 at this point still. So, it's been a learning curve to say the least. And a lot of stuff has changed. But that brings me on to the M1 Finance portfolio. Something that I really am considering doing is honestly, at this point, I'm really considering putting it into something like SPMO or SCHG or VUG. And the reason why, if I pull those up here, or I think it's VUT, no, it is VUG, right? SPHG, or SCHG, I'm sorry. And then SPMO, which is the one I'm most interested in right now. Now, these are all growth funds, or these two are growth funds, and this one is a momentum fund, right? So we're about to see that. But you can see since this is a year, but let's go back to that May 19th date real quick. And if we come back over here, so we can see since we've been tracking this, our M1 Finance portfolio has been up 12.9%, which in that same time period, SPY has been up 11.3%. So we are beating it there, right? We aren't beating it because our total portfolio has gone down because of our Composer portfolio and, other stuff. But if we look at this, you can see, VUG, SCHG, SPMO, these are all very high compared to SPY. If we go to year to date, for example, you can see even more of a return. You can see SPMO is at a 26% return right now, which is crazy. We go 1 year, we can see how that compares as well, and 3 years as well. So, yeah, I guess on this 3-year time span, it's not crazy different, but yeah. SPMO is very interesting. It's something I've been looking into. If I didn't go through SPMO, it would probably be VUG, because that is just seemingly the best one. And if we compare on stock analysis, SPHG, they have a 0.04% expense ratio versus VUG, which has a 0.04. But something you'll notice is if you look at assets under management, we have $1.93 billion. On SCHG, we only have $50 billion. Now, the reason I would guess the reason for this is actually not because VUG is just that much better. It's probably because a lot of people have retirement stuff already, it's like auto in, and Vanguard has been a thing for a long time. So that's probably why they have more assets under management. So there's that. And the reason I want to do this, by the way, is probably just to reduce the amount of work that we need to upkeep this, as well as we're paying a 0.04% expense ratio for someone to do that for us, right? Because basically it is beating us since May. Actually, shouldn't have closed that. Hope this has it. If we go back to May of this, so May 19th, just a reminder that SPY here is showing 11.69. Both of these, or all three of these, are beating it, right? So that's why I want to do it, because it has, relatively speaking, the same drawdown risk compared to the other ones. Now, another reason I didn't want to go, the reason I want to go in SPMO over VUG is something you'll notice is if I go over here, VUG primarily is a technology. Wait, maybe I'm thinking about something else. Because if we look at SPMO, I think they have a similar holding structure. I just don't want something that's completely in technology. Okay, there we go. This is what I mean, though. So if we compare the two, we have 50% in technology, and a large percentage of that is in NVIDIA, 12%. That's a lot. Now, these aren't that much better in SPMO, but it is better, right? First of all, NVIDIA is at 9, AVGO is at 10. The percentage as a whole, though, is a lot lower. You can see that they have MSFT, Apple, and Nvidia at the top. I have no doubt that these are good companies, but the problem is, especially in Nvidia's case, they have been on an astronomical bull run, and a correction could take out this fund very easily because it's such tech heavy. With SPMO, it's a little bit more balanced. You can see obviously the pie slices are a lot more even. You have technology and financials pretty much at the same percent. Same with communication services and consumer staples. The rest kind of trickles down, and that kind of makes sense. So that's why I was looking into this one, and it actually does perform better on certain cases. Now, if I come over here and compare the three, VUG, SP, or SCHG, I don't know why I keep doing that, and then SPMO, also compare it to SPY, and we set these all equal because I think it will complain otherwise. And again, this is starting at 10K with $0 in. This is what it will look like, right? So first of all, this goes back to 2015, October 12th, 2015. So about 5 years, or sorry, about 10 years exactly. What you'll see here, though, is the CAGR. First of all, the CAGR is something we should always be looking at because that's basically our average annualized return. So here you can see SPMO is actually on top, SPY is on the bottom. That makes sense. SCHG is actually beating VUG. Now, the second thing I would be looking at is max drawdown. You can see also on the bottom is SPMO. Now, my guess is this is the difference between momentum and the growth ETF. Even if we look at SCHG, their holdings are almost identical to VUG in that they have such a high growth allocation towards tech. Now that makes sense. Obviously, we're in a tech boom right now, but at the same time, I guess I would like a little bit more drawdown protection. You can see also it is the second lowest volatility of the four, very close to SPY, and has the highest Sharp. Now, obviously, Sharp's pretty much as close as you can get to a perfect metric because it takes different concept. It takes your return, takes your drawdown and your volatility, I believe. So it's very good. Something like Kalmar only cares about your returns compared to your max drawdowns, so it doesn't really factor in volatility and so on and so forth. So Sharp and Sortino are very good, and you can see in actually all of these categories that SPMO is actually beating these. So SPMO is that yellow one. Even if we go and say, okay, we actually don't want to test back to let's just say the start of this year. And the reason I'm doing that is to try to remove the recency bias using the tariff boom. Because obviously we had a big drop, but if you were positioned right, you actually would have profited quite a bit off of that. And that's the same case I'll get into, or I have gotten into, I'm sorry, in the composer strategies, the algorithmic trading stuff, is because people make these strategies, look at the back tests, and that's basically what they see. So we can see here that the the CAGR after that removal is actually SHG. And then the second one is SPMO, and the third one is VUG, right? And if we take a look at the drawdown, it's about the same, and the volatility is about the same. The Sharp, though, the Sharp ratio is actually still in SPMO's favor, and so is the Sorrentino, and so is the Kalmar. So there you go. That's without that massive gain. Now, obviously, there's been other areas, but that's the one I was most interested in. One more thing I want to take a look at is if we remove this and we say, okay, and this is something I'm going to get into in the composer stuff, but what does it look like if we actually put in cash flow? Because I think most people can't just put in $10,000. This is just hypothetical. Let's say that was your starting point. But most people want to actually put more and more money into their portfolio. They don't want to just let it sit and ride, right? So let's say we put in $1,000 every single month, right? Because this is important too, because this will change um, based on obviously your cash flow frequency. It will actually change how these things work. And you can see here, SPMO has now a 20% MWRR. Before it was the same as the CAGR because you don't have additional cash flow, which is crazy, right? And you have around the same values for max drawdown and volatility, which is great. So, yeah. Anyways, I think that is it for this side of the portfolio. It's just something I've been thinking about. Um, because again, it's a lot less worrying. I was looking the other day at the holdings. Now, a lot of them have gotten very good, but some of them haven't, right? And I don't really want to have to worry about changing these out quarterly or biannually or annually, whatever it may be, because it just gets tiresome, right? I have a lot of other stuff going on. I have work. I have a lot of the algorithmic stuff that's keeping me very busy. So it's just a lot. But, we've done great so far. Um, we're kind of in between the growth ETFs and SPY at, I think I said 12.9% versus the 11.3%. But again, if we were in SPMO, SCHG, or even VUG, we would have been around the 14-15% at this point. So that's why I'm a little bit disappointed. But, it is what it is. But let's finish off the M1 Finance portfolio over here. So the top winners for this week, big gains from Prologis, 11.5%, and the other two about 2%. So probably was brought up by that. We have utilities next. At the highest one was NextEra. And last but not least, we have. Oh, I'm sorry, that was wrong. Second one was semiconductors. The largest gain there was AMD, and then second largest was AVGO. And then last one we go through, so we have a 7% gain from Google. I think Google last week was a little bit down, so that kind of makes sense. It kind of rebounded. We only had one sector that was actually red, it looks like, and that was healthcare. The largest loser there was Eli Lilly, 3.6% down. Then we had utilities. The largest loser there was the Southern Company. And last but not least, we have consumer discretionary. And the largest loser there was Amazon at 1.5% down. So, yeah. And in terms of any recent dividends, we have had, I think, one at O Realty Income. So there's that. All right. I know this video is dragging on, but I have made a few changes to the portfolio. So let me demonstrate those now. So first of all, I did completely sell out of every symphony that I was in. And there's two reasons for that. One, I wasn't really happy with the performance they were going at. Two, I was planning on doing that anyways, because you can see this is actually basically the same strategy, just packed into one symphony. And there's a reason for that I'll touch base on later, but going over the weekly performance, we did pretty well. I think I sold midweek because, first of all, I did make a deposit, but it didn't get cleared because on Monday the banks were or it was a bank holiday. It wasn't a stock market holiday, but it was a bank holiday. So I deposited my funds on Saturday or Sunday or something like that. And what ended up happening is it took so long that I didn't get my deposit fully in my account, I think, until Tuesday after market, right? And then I had to make a decision whether or not I wanted to do something. So I could have woken up early because the stock market here, I'm in Pacific time, would open for me at around 6:30 a.m., right? Not around. That is when it opens, which is very early for me. I am not going to do that. The problem is if I do it the other way, which Composer only offers one trading window, and that is 10 minutes before market closes. I have to say that beforehand, right? That's fine. But there's a whole thing going on in my head because I've been playing around with the deviation stats, which I'll get into in a second, and determining whether or not that was actually going to deviate us because I found a few things that were interesting. Um, Along with this, I did notice that. So I think come Wednesday, right? Wednesday was around the time. Maybe it was Tuesday. I don't. It must have been Wednesday. I can actually tell. Let's see. So it probably was Tuesday or something like that. But what ended up happening was I took out my money and I was going to decide when. Yeah, you'll see here. I was going to decide when to actually go into the fund. What ended up happening was I decided at uh 12:45, which is 15 minutes before the market closes. I literally decided that minute. I took out all my stuff and decided what to go into because I was going to swap it. Well, what ended up happening was, unbeknownst to me, Composer trades at 12:45 or 12:50, or you know, 3:45, or 3:50. You get my point. 15 minutes before market closes. Or sorry, 10 minutes before market closes. The problem is they do their calculations 15 minutes before their market closes. And it was 12:45. I tried to put in money and it said, "Sorry, there's no trades. You can't basically add money while the trade window is starting." And it was literally, I looked at the clock because I had the seconds, you can see. It was like 20 seconds past 12:45. So I got really unlucky. But anyhow, we went all in on our BF. This is the one that goes back to 2007, has a pretty good max drawdown and volatility. This one, again, this is what we were mostly in, was that only goes back to 2022, and that's why I was a little bit scared. Plus, I was seeing a lot of deviation between the live and the backtest, and that's what I wanted to do. I also have this one. I have $50 here, and that's another reason why I bought this again, is because I wanted to see, actually, it's a lot easier to track one symphony than it is 5 collectively. So I wanted to put $50 in here. That's the minimum deposit that you can put in just to track. But you can see we're almost caught up to the amount we put in. We put in about, well, my guess would be, well, I can put it up here, I think. So net deposits is $7,098. So we're about $50 off, 52 bucks off, or no, yeah, $52 off. So we're close. Now let me pull up the thingy here, the stats, because I would like to show you guys something. So of course the deviation has changed. Also, all these stats are maybe not the most accurate because of the Composer's API. It's a pain in the butt to work with. They don't give us enough data. But if you take a look here, so this is the one that we were going with, right? There was already some deviations here, but this is when I did the deposit. And so what I wanted to check, because I ran some tests and I think I saw the largest deviation started to happen right after we actually deposited more cash into the symphonies. Now that kind of makes sense, but I wanted to validate that. And you can see here that that may or may not be true, because that also could just be, it might have just been coincidence, honestly. And the reason the way I'm kind of coming up with that conclusion is, if you look here, this happened. We put more money in here, right? This is that BF portfolio. We put more money into here, and there was that deviation, the largest that there has been, by 10 cents there. And then also there was a deviation here that we didn't add more money into this. And this actually jumped from low to moderate risk score. You can see that the correlation's quite off, and then the tracking error. And something that needs to be shown here is the RMSE, the root mean screen error, root mean RM. Squared error. Squared error. Anyways, the whole point of this is basically how well it tracks the backtest, right? So that was something I've been looking into. Um, but I don't know. I think we just have to let it play out a little bit more because I was looking at some of the other symphonies that were kind of around this and the moderate score, and they actually did perform very low. Like I basically graphed out their risk score over time, and I looked at them and I said, okay, well, that's interesting because they both started about the same level as this BF one, which remember last week this was around 3. The risk score was around 3. And they both started around there, which also kind of makes sense thinking about it now because, the longer you go, the large the more chances you have to deviate, so it kind of makes sense in terms of probability. Um, but on top of that, I also remembered that obviously there is this is working to a certain degree because all of them were differently scored, and the ones that I had predicted to be the most volatile or the most deviating were actually the ones, right? So the KMLM and the foreign modified foreign rant. So I don't know. I just really need to look into this a little bit more. Overall, though, I think this is still pretty respectable on both cases. So yeah, we'll just have to keep going. I did also look at a few other ones. So these are the two most popular that are like honestly, they're like some of the oldest, but a lot of people on the Discord have um really had success with these, right? You can see here it goes back to 2011, has a max rate on pretty high, but also gives you pretty good annualized return. And has 6 tickers, very good. And even better, the logic is very short, right? This is what got everyone into the Composer platform is TQQ for the long run. It was made by a guy named Derek. Very awesome guy. He's very smart. And so he made this a long time ago. You can see this one's from 2023, but I don't even think this is the original one. And then if we go into Holy Grail, this is equally as important in the community. You can see it has a little bit less max drawdown, but also less annualized return. Has 6 tickers, and also very short logic. This one's actually shorter. So, these are some of the things I've been thinking about. Maybe what we could do is balance portfolio in terms of just having some of these high risk ones at like very low percentage and then having the other ones. It just really depends. I honestly, if it does stick to this level of around a 49% annualized return with these low stats, I will totally take that. And just a reminder, this goes back to 2007. So, it's pretty good. 49% annualized return all the way back to 2007. It's pretty good. Pretty good. So, all that to say, a lot of gears are turning in my head. And, I'm trying to think as much as possible how to maximize the money that I have now, and hopefully prepare for the future. And, who knows? I might fail. And I mean, obviously, on this side of things, I'm not really doing the best. But ultimately, that's okay because I'm learning quite a bit about all these stuff. I'm learning more statistics and stuff behind the scenes and how to kind of determine other strategies. And this isn't just for Composer, this goes along with other algorithmic strategies. So if I really wanted to go deep down and build my own news tracker or whatever like that, and I actually was playing around with that earlier this week with the Trump tweets. I was doing sentiment analysis on his Truth Social truths, I think is what they call them. But I was playing around with that, but I could basically take a lot of these lessons that I've learned and add that. So that's like the most important lesson that I've learned since I've started trading is it's okay to fail. As long as you're not putting 100% of your portfolio at risk, it's okay to fail, right? I mean, that's fine. That's going to be the same way you learn in life with really anything. You want to learn tennis? Well, you're not going to be just the best person ever. You're going to, you're going to have to push your body. You want to, be a good student. It's the same thing. You're going to put a lot of time into it and you're probably going to fail. There's going to be times that you studied for something and then there's this other thing. And so it doesn't, my point is soak up as much knowledge as you possibly can and make a very educated decision on what you do. So, and I think anyone that does that, anyone that takes that advice will prosper. And yeah, as always, guys, I wish you guys a wealthy future.